Welcome to This Explainer. Today, we're settling a massive 40-year battle in the world of finance. We're doing a deep dive into a really common misconception, the whole myth of buying the dip. You know the drill, right? Keep your powder dry, wait for the market to crash, and then just back up the truck and buy everything at a massive discount. I mean, it sounds so incredibly smart, but today we're going to look at the actual mathematical reality of trying to outsmart the market versus doing absolutely nothing but investing consistently. Let's get into it. Okay, let's set the stage here by introducing our two perfectly matched competitors. Over on the left, we've got Cole. Cole is disciplined, but, well, he's anxious. He's sitting on a pile of cash, just constantly waiting for that perfect fire sale. And on the right, we have Carol. Carol is totally lazy. She automatically invests $300 into a broad index fund on the first of every single month and genuinely could not care less what the market is doing. Blood in the streets? She buys. All-time highs? She buys. Now, they're the same age, they have the same job, and they have the exact same $300 a month to invest. It's a completely fair matchup. But over the next 40 years, one of them gets quietly mathematically demolished.
Section 1. The hidden cost of waiting.
So, to really understand why waiting is so costly, we have to compare how the market actually behaves against how Cole thinks it behaves. Look at the stretch from March of 2009 to February of 2020. The market climbed for nearly 11 straight years without a single bear market. Over that totally agonizing stretch for a dip buyer, the market returned roughly 400%. Just picture Cole sitting through that entire run. His cash is basically rusting in the driveway, earning practically zero while he hits refresh on his watch list, waiting for a crash that just refuses to show up. Meanwhile, Carol's $300 is going in every single month, quietly compounding on top of the month before. Cole thinks he's being patient, but mathematically speaking, he's just doing absolutely nothing while the most powerful force in finance works entirely for Carol. And you know, it gets even worse for Cole. 7%. Since 1950, the S&P 500 has spent roughly 7% of all its trading days closing at absolute record highs. But here is the crazy part. Almost a third of those record highs became permanent floors, meaning the market simply never dropped below those prices ever again. So when Cole is sitting around waiting for a dip, practically speaking, he's waiting for a price that his cash will literally never see again. He's betting against a loaded coin over and over, and he's using his own financial future as the chips.
Section 2. Testing perfect market timing. Charles Schwab actually ran a brilliant study testing this exact scenario. They basically gave an investor a magical crystal ball to perfectly time the market over 2 decades. This perfect timer magically bought on the exact lowest possible day every single year. They finished with $186,000. Now our autopilot investor, basically Carol, just fed money in blindly every month and finished with $166,000. So 20 entire years of literal godlike perfection only beat Carol's incredibly lazy strategy by about 20 grand. That's just $1,000 a year for absolute omniscience. But look at the cash waiter on the right. Cole's whole strategy of keeping powder dry and waiting for the absolute right moment finished with just $47,000. The patient genius got completely obliterated. Oh, and Schwab ran one more scenario that is just a brutal reality check. They modeled the unluckiest investor imaginable. We're talking someone who deliberately bought at the exact peak, the absolute worst possible day every single year for 20 years. That total cosmic disaster of a portfolio still beat Cole's cash waiting strategy by a factor of 3. No joke, buying at the worst possible moment on purpose beat waiting in cash for the perfect moment. Being in the market on terrible days turned out to be a rounding error. Not being in the market at all was the real catastrophe. And if you stretch that gap across a whole lifetime, the math honestly stops being sad and just starts being comical. $100 dropped into the market back in 1928 would be worth well over $1 million today. That exact same $100 bill kept completely safe in cash the entire time, about $2,500. Every single year Cole spends waiting in cash, he is quietly choosing to buy himself a nice dinner over creating generational wealth. It's wild. Section 3. The flaw in God mode.
Let's keep building on this with some incredible research from finance writer Nick Maggiulli. He compared an all-seeing dip buyer against our completely boring, mindless monthly investor across literally every 40-year stretch possible since the 1920s. The result? The mindless dollar-cost averager wins 70% of the time. Just let that sink in for a second. Even with perfect, magical knowledge of every future bottom, the omniscient dip buyer still loses to Carol's autopilot strategy 7 out of 10 times.
But obviously Cole doesn't have God mode, right? He's a human being. And if you take away that omniscience,
If our dip buyer misses the exact bottom by just 2 months, their win rate plummets from 30% all the way down to a dismal 3%. And let's be real humans aren't usually off by just a few weeks. They're usually off by a country mile in the exact wrong direction.
The math here is incredibly unforgiving, and it breaks down to three really simple reasons why the dip buyer loses. First, your cash just sits idle, earning next to nothing while you wait. Second, the market continuously drifts upward, so those bottoms you're patiently waiting for, they are often way higher than the everyday prices you could have just bought at years earlier. And third, missing just one major bottom absolutely kills the entire strategy. Like in the stretch from 1995 to 2018, this single purchase made at the March 2009 bottom accounted for over half of the dip buyer's entire final portfolio. Think about that. If you hesitated even a tiny bit, like literally any normal human being would in the middle of the scariest financial meltdown in 80 years, half of your wealth simply evaporates.
Section 4. The psychology of crashes. So we've talked a lot about the math, but there is a massive gap between a theoretical paper strategy and how actual humans behave. The research firm Dalbar actually tracked this. Not what investors claim they'll do at dinner parties, but what they actually do with their own money. In a recent year where the broader market returned roughly 25%, the average equity investor earned just 16.12%. They left over 8 percentage points sitting on the table. Why? Well, because they panicked. During the scary stretches, they didn't buy the dip, they actually yanked their money out of stock funds. And the biggest withdrawals landed right before the market completely ripped higher. See, Cole's entire strategy depends on him being this perfectly calm, hyper-aggressive robot exactly when every human instinct says he's going to be terrified and frozen. A real crash isn't some flashing green light that says buy now. It's a wall of screaming blood-red headlines. It's opening your app and seeing your retirement account suddenly down 40%. It's your spouse asking if you should just get out before everything goes to absolute zero, and there's a very loud voice in your own head agreeing with them. The dip buying strategy asks for the absolute most courage at the exact moment you have the least. But Carol? She never has to be a robot. That is her ultimate superpower. She just removes human emotion from the equation entirely. She doesn't have to try and call the bottom or summon any bravery at all because her $300 automatically buys right through the scariest moments without her feeling a single thing. She turns market crashes into her absolute best purchases with zero courage required. As the saying goes, Carol never gave herself the chance to be smart, which means she never gave herself the chance to be wrong. Section 5. The Trap of Cleverness. As we wrap up this 40-year tale of our two investors, it all really boils down to the ultimate myth of the clever investor. Cole walked into this believing the secret to investing was being right about the market. His trap was a burning desire to outsmart it, and mathematically speaking, it completely destroyed his portfolio. He spent years sitting on the sidelines, missing out on absolutely massive runs. Meanwhile, Carol walked in and proved that the actual edge in investing is never needing to perfectly time anything at all. Her portfolio compounded relentlessly because she flat out refused to let cleverness get in the way. The reality is, the market absolutely does not owe you a crash. So the very next time someone tells you they're keeping their cash ready, just sitting on the sidelines waiting for that perfect entry point, I want you to ask them this one question. How long are you willing to wait? Because while you wait around for the perfect moment just to prove how smart you are, the only thing actually compounding is the cost of your wait. Thanks for joining me for this explainer. I'll catch you next time.